Each of these near misses highlights the same underlying vulnerability. Opaque, leveraged positions in the shadow banking sector can unravel far faster than anyone expects. Recent episodes in global finance show how quickly stress can emerge from the shadow banking sector and threaten the broader system. The European Central Bank has repeatedly warned about the risk of instability spreading from non-bank financial firms to traditional lenders, especially during market turmoil. Banks now have direct exposure to shadow banks through trillions in loans and investments, making them vulnerable to shocks that originate outside the regulatory perimeter. The COVID-19 market shock in March 2020 provided a clear illustration. Money market funds saw $125 billion in outflows in just 1 week, and fixed income funds faced even larger redemptions, particularly those offering daily liquidity but holding less liquid assets. This mismatch between what investors expect and what funds can actually deliver forced central banks to intervene with emergency liquidity measures. The Financial Stability Board's chairman has since underscored the need to address these liquidity mismatches in money market and open-ended funds, as these structures remain susceptible to sudden runs. Private credit is another area where rapid growth has introduced new risks. Non-bank lenders now hold 68% of leveraged loans, according to recent OECD and PYMNTS data, with total loans rising from $15 trillion before the Great Recession to $21.9 trillion today. These loans often go to borrowers who cannot access traditional financing, and when conditions deteriorate, as seen in early 2025 when private credit default rates rose from 5% to 5.7%, the impact on non-bank lenders can be severe. The expansion of private credit has filled a gap left by banks, but it has also concentrated risk in less regulated corners of the market. When stress emerges in one segment, it can ripple through these connections before regulators even realize the extent of the problem. They are signals of how quickly liquidity can evaporate and how reliant both banks and non-banks have become on one another. Each of these near misses highlights the same underlying vulnerability. Opaque, leveraged positions in the shadow banking sector can unravel far faster than anyone expects. The system's size and complexity makes it difficult to track risk in real time, and the lack of direct regulatory oversight means that problems often become visible only after they've already spread. Understanding these warning signs is essential, because the mechanics of a shadow banking collapse differ fundamentally from the last crisis. What happens next is shaped by the speed and opacity of this system, and why a future crisis could unfold much faster than before.